Hello people, this is Dr. Wang here recording. I hope this video clip finds you guys safe and healthy. Today we're going to finish off the chapter for cash budgeting, and you will need to do another take-home quiz based on the topic. But before I move on to the materials, I want to formally apologize to you guys about the hassle of doing the assignment for the video on the canvas. So what happened was St. Xavier has switched the video provider from one company to another one, and it just happened to end during the time this video was assigned. Some of you did watch the video and turned in the assignment before the link expired, and some of you, however, started relatively later, and well, the video was not good anymore. So if you have paid to watch the video for this assignment, I will recoup your cost by the end of the semester with the interest. So if you pay $3, I will pay you $5. If you pay $4, I will pay you $6. Okay, so that cost is on me. Well, I know that this assignment has been changed to extra credit activities, so you don't have to do it. If you want to boost up your grade a little bit, definitely you are welcome to do it. Okay, so now back to our chapter. Let me just zoom myself out a little bit. And here is the PowerPoint you can find on the canvas. And this is about cash budgeting. Cash budgeting basically is another name for short-term financing and planning. And you are dealing with accounting items that change within a year instead of changing across years. And you will need to plan your borrowing and also short-term lending according to your cash level. Okay, so right here, what you see is a equation based on the universal accounting equation: total assets equals to total liabilities plus total equity. So what you see here is the net working capital basically is cash plus other current assets like inventory, accounts receivable, minus current liabilities. So basically these are current assets and this is current liabilities. That makes your net working capital. And if you put net working capital right here, basically you plug in equation 2 into equation 1, then you will see a current assets minus current liabilities here plus fixed assets equals to a long-term debt plus equity. And if you move current liabilities from the left to the right, then you will see a cash plus other current assets plus fixed assets equals to current liabilities plus long-term debt plus equity. So it's just a simple algebra, and I'm not going to detail of that. So, but I do want you to realize that your cash could be affected by these four major groups of factors. One is long-term debt, another is equity, like the owner withdrawal and more equity investment. You also have net working capital, which is a negative. So basically, if you have an increase to inventory, which is a part of net working capital, then your cash would be reduced. If you pay off your accounts receivable, which is part of net working capital, then your cash will be reduced. If you collect your account receivable, then your cash would increase. And you also need to deduct the change of fixed assets. So basically, if you spend money on plant property and equipment, then your cash would get reduced. Okay, so here is something we have learned before from the statement of cash flows. So the increase in long-term debt and equity leads to an increase in cash, and the increase in the assets, no matter it's fixed assets or short-term assets, it just decreases your cash. All right, so this is a topic that will be on your quiz in this week. So what you see here is the operating cycle and cash cycle. This is a timeline. So let's say you are a manufacturing company and you need to order raw materials. So you need to place your order and then the stock will arrive. It takes some days to arrive. And then the firm should receive an invoice. The invoice is basically telling you you need to pay the bill. You don't have to pay it upfront because things are operated in your credit instead of in cash. And then after a certain time period, like 30 days or 60 days, you need to pay cash for that invoice. So that is when the cash is delivered. So this is called a accounts payable period. And then from the from the time the stock arrives until you finish your production, this is called the inventory period. Okay, so basically you make a big change of from the raw materials to the finalized goods. Okay, and then you need to make the sales. Okay, you need to sell your finished goods to the market, and this is called accounts receivable period. So when you finish the goods and then you sell it, okay, when you sell it and then the cash is not received upfront. As I said, everything is done on a credit basis, not on a cash basis. So you need to invoice the buyer of your product and then give them like say 60 days or 90 days to pay your bill, and then you receive the cash. So this whole period is called accounts receivable period. And then from the time the stock arrives until you receive the cash from the products you sold, this is called an operating cycle. And from the time you pay cash for the raw materials until the time you receive the cash for the final products, this is called a cash cycle. All right, how to calculate each of this period and cycle is your primary task for the upcoming quiz. First of all, when you calculate the inventory, you need to know the turnover of the inventory. As the definition says, inventory period is the time between stock arrives and finished goods sold. And for accounts payable period, likewise, you need to know your payable turnover. And the accounts payable period is the time between stock arrives and the bill paid. Accounts receivable period is the time between finished goods sold and the cash received. And the cash cycle is the time between cash paid for materials and the cash received for final products. Okay, so operating cycle and the cash cycle basically falls into this relationship. Cash cycle is operating cycle minus accounts payable period, as you can see from the timeline in the previous two slides. So in practice, the inventory period, the accounts receivable period, and the accounts payable period are measured by days in inventory, days in receivables, and days in payables, and all of this could be calculated through the turnover ratios. So here is an example. This is the information from the balance sheets and also income statement. And for the inventory, you have the beginning level of the year, which is 200,000, the ending level of the year, which is 300,000, and you also have accounts receivable at the beginning of the year and at the end of the year. Also accounts payable, and you also have a net sales. Net sales, basically the money you receive from selling your final product. And you also have a cost of goods sold. That's the money you pay for buying the raw materials. Okay, so the beginning and the ending cut the time equally, and we are assuming that the inventory or accounts receivable and payable, they all change on a linear basis. So they gradually change from 200 to 300, from 160 to 200. So what's the overall annual inventory level? You just need to take the average of the beginning and the end for account receivable, for payables, and also for this inventory. So everything needs to take the average of the beginning and the end level of the year. Okay, so now when you calculate the inventory period, you first need to find the annual inventory at the average level. So you use the beginning plus the end divided by 2, that's the average. And you use the inventory turnover. So where the money on the inventory or the number of the inventory basically resulted from the price you pay to buy those inventory, to buy those raw materials. So for the whole year, you paid $820,000. That's your cost of goods sold. So this is the cost of goods sold divided by the overall inventory. Okay, so during the whole year, you pay this much for your inventories, and on average, your warehouse holds 250,000 worth of inventory. So that basically means you buy more inventory than the inventory the warehouse can actually hold. So that means you need to constantly replacing the existing inventory with new inventory. So when the old inventory is used in the production, you fill it out with new inventory, and then this inventory get used out for production. You used another inventory to replace it. So you're just constantly replacing your inventory with your newly purchased materials. And this 3.828 is the inventory turnover. That basically is telling you during the whole year, on average, your warehouse or the inventory you hold is replaced by the cost of goods sold by 3.28 times. And then you use the number of days in a year divided by this turnover ratio. So if during the whole year it got replaced by roughly 3 times, then it takes about 1/3 of a year to replace it once. So the exact number is 112 days. That's from 365 days in a year divided by 3.28 in turnover or times of replacement. So it takes 112 days to replace your inventory just once. Okay, likewise, you can calculate the receivables period. You take the annual average by taking the beginning added by the end level divided by 2. So that's 180,000 for the average accounts receivable throughout the year. And then your receivable turnover basically comes from the total sales. You see, when you sell something, you should receive money, right? And if you receive money in credit right now, that should be billed as accounts receivable. So instead of using cost goods sold, you should use sales here. But for inventory, you should use cost goods sold because that's associated with the raw materials, both the inventory and the cost goods sold. But for the receivables, if you receive money, that is generated from the final product you sold. So you have to use sales for the calculation. All right, so the result here is 6.39 times. That's the receivables turnover. That is telling you that on average, your accounts receivable is replaced by sales 6.39 times. Each time you make a new sale, you have account receivable, some money to collect, and then you wait some time, then you get paid in cash, and that account receivable is collected, so it's gone, it's right off. How many times does it take during the whole year? It takes about 6.739 times. Okay, and the receivables period here is 365 divided by the turnover ratio. So it takes on average 57 days to collect your bill from the time the bill got generated until the time you collect the money and write off the bill. It takes 57 days. From the inventory period to the receivable period, when you add them up, you can get operating cycle. So that's 169 days. For payable periods, again, we're gonna use the same procedure, and we're gonna take the annual average of accounts payables, beginning and end here. Then we use the cost goods sold divided by the payable on average. So because you pay for the raw materials, and that's part of your cost goods sold, so you are using cost goods sold here. You don't use the sales for that number. So you got this turnover ratio. You use the 365 divided by that turnover ratio. You get the length of time that is payable, this invoice got paid off. And your cash cycle is 169 minus the 39 payable periods. So that's basically your operating cycle minus your payable period. That's your cash cycle. So this is what's the point of that? If I go back to the timeline I drew earlier, so you will see that this right here at the end of the accounts payable period, that's the time you pay the money. Okay, so that's the time you pay the money, and you don't have that particular money, and you do not receive new money until right here, the end of operating cycle. So this is called a cash cycle. This is a time that you are in shortage of a cash. Okay, from the time you pay cash until the time you receive cash, that is the time you have a shortage of cash. We call this a cash cycle. Okay, so the implication here is if we are in a cash cycle, then we will find a way to finance it, to fill out the hole. Okay, we have to finance our inventory for 130 days, and we need to constantly keep examining these receivables and inventory periods to reduce the financing needs. So, which means the shorter cash cycle is better. In terms of short-term financial policies, we have some elements to consider. First is the size of current assets relative to total operating revenues. And the second is the proportion of short-term debt to long-term debt. Okay, so and you can develop a flexible or a restrictive strategy or a policy style based on these two components. So for a flexible strategy, you are expecting to see a high ratio of current assets to sales and a low ratio of short-term debt and a more long-term debt. That basically means you have more short-term assets like a cash, accounts receivable, and inventory, which could be converted to cash, and you have a less short-term obligation to fill. Okay, because you probably have leave the problem to the future. Okay, in the form of a long-term debt. On the other side, the restrictive policy would expect it to be low ratio of current assets and more short-term debt and less long-term debt. So you have more problems to deal with now. If you don't have a lot of cash, just like a lot of small businesses are affected by the coronavirus right now, they are like being strangled. So if they don't have enough cash flow, the business may not survive the next month. Okay, so the size of investment in current assets. So if you have a flexible strategy or high ratio of current assets to sales, then you will keep large cash balances and short-term investments. So this short-term investment could be in marketable securities or even certificate deposit, bankers repurchase agreement, commercial papers, and so on. You can also have large investments in inventory, okay, and you can have liberal credit terms, so which allow you to borrow more. Okay, that must be under the precondition that you don't have too much short-term debt at the current point. So if you don't have too much short-term debt, you can borrow more in the short run. And restrictive is the opposite. It gives a low ratio of current assets to sales. So you have a low cash, no investment to spend for marketable securities or the other financial products, and you have no money to make in the short run in the inventory. And of course, because you have too much debt, and you just make no credit sales because you cannot allow the waiting period until the cash arrives. Okay, so if you want to make the sale, and if you have a very restrictive policy, you demand to be paid in cash. So there would not be accounts receivable built in your balance sheet. Okay. So alternative financing policies here. So basically, I have explained some of them. Flexible short-term finance policy, you have a low proportion of short-term debt relative to long-term debt. And in the restrictive, you have a high proportion of short-term relative to long-term. So in the ideal world, we can't say flexible is superior or restrictive is superior. We ideally want to keep short-term assets financed with short-term debt, and long-term assets financed with long-term debt. Okay, so we want to keep the money inflow and outflow in the same pattern, and that basically gives a zero net working capital in the short run. So the costs of an investment in current assets are twofold. There is a type of cost called a carrying cost, and that basically is the opportunity cost for hoarding too much cash or current assets instead of investing them. So you are not getting the interest. Even you put in a short-term assets, like say if you invest your money in current assets like marketable securities, you are getting lower return than you could get if you invest the money in the stock market for a longer time period. Okay, so that's a carrying cost for holding too much current assets. And there's also shortage costs, the costs that fall with the increases in the level of investment in current assets. Okay. So there's a breakage cost for cash holders, and also there is a cost of lost sales, goodwill, and a schedule reset. So that happens. All of this happens when you do not have enough cash to run your business. Okay, and if you have enough cash or current assets, the shortage cost would fall. Okay, so in the world of finance, we always find the state-in-art balance of the costs, carrying costs, and shortage costs. Okay, so if you put more and more investment in the current assets, let's say just in cash for the simplistic purpose, then your carrying cost will be higher and higher because you're not getting interest if you invest that cash in another place, in a bank, for example. Okay, but if you put more and more current assets, then you would have a less and less shortage cost. As if there's some a sudden odor, like a sweet peas had a big candy odor, if they have enough inventory, they could just make up the candies and fill the odor in a timely manner. But if they have not invested enough in the inventory, in the cash to buy the inventory, then they would lose that order, and that is a shortage cost. Okay, in summary, the higher investment in current assets, then the lower shortage cost there would be. So you always want to reach the nice balance of this. If you add the carrying cost and the shortage cost, there should be a U-shaped curve with a minimum point. Okay, that minimum point basically is your optimized current assets level. Does that look familiar? I think it does. In the previous chapter for the cost of debt, we know that there's the benefits of debt. As the debt level increases, there's the tax benefits in dollar amount also increases, but the distress cost associated with debt also increases. Okay, so it's kind of combining the benefits and costs and reach to a nice balance, which is called optimum. All right, so if a company wants to adopt a flexible policy, so that must be this company's minimum point is skewed to the right. So the nature of their business gives this curve for carrying cost and this curve for shortage cost, and that basically gives a higher optimized current assets. So it's not really a choice by the company. It's really the nature of their carrying cost and shortage cost decided by its industry. And also for the restrictive policy, well, it's also decided by their own nature of a shortage cost and carrying cost. And that basically makes their optimized current assets skew to the left. That is when the total cost of holding current assets is the lowest. So it is also determined by the industry of this business. Okay, so the cash budgeting here records the estimates of cash receipts and disbursements. So you receive cash from sales, and you need to estimate when actually you will collect those cash. Just like the Excel project we did, when a sale occurs, some of the payment is made upfront in cash, and some of it will be paid a month later, and some will be paid 2 months later. Okay, and you also need to consider cash outflows, like payments to accounts payables, wages, taxes, and other expenses, and these are all in the Excel exercise we did together. Okay, and you also need to handle short-term borrowing if you are in a financing need. If you paid a lot of cash but you have not received the cash you make yet. So short-term borrowing is the most common way to finance a temporary cash deficit and to finance it with a short-term loan. So you can just borrow a unsecured loan, just a line of credit at the bank, or you can borrow a secured loan, which usually provides a collateral. Okay, if there is a collateral, that means the loan is secured. If just a credit, then it's usually an unsecured. Okay, and you can also issue commercial paper. The company can issue commercial paper to finance the short-term cash shortfall, and the company can also trade credit with another company, just like different banks trade with each other for their cash to meet the minimum Federal Reserve requirement.